Well, good afternoon, everybody. It is 5:30, and I think the majority of people have now joined. With me today, I've got Jonathan Laredo and Charles Peach from Yugo REIT. Jonathan and Charles are going to go through the presentation, and then at the end of the presentation, there will be the opportunity for question and answers. Given the number of people that we've got attending this afternoon, it's not possible to go to people individually and unmute them. But what we would ask you to do is please use the Q&A button at the bottom of your screen, type in any questions that you have for Jonathan and Charles, and I will put them to them at the end. We really would like your questions, so anything that you would like to discuss, please use that function, and we'll put them to the team at the end of the presentation. So without further ado, I'll hand over to Jonathan and run you through the presentation. Jonathan.
Thank you, Tim. Good afternoon, everybody. Charles and I are going to take you through Yugo strategy highlights, the interim results for the 6 months to June 2021, and a snapshot of our portfolio and our asset management activity. It may be that some of you, I understand that some of you do not know the company, so I'll be covering ground that some of others of you will have already heard, so apologies for that. But I think it's better that everyone hears the full story than a partial one. Tim, if you can take us to page 5, please. So Yugo is an Irish REIT. We invest in commercial real estate situated outside the centre of Dublin city centre, in offices, and industrial buildings. Principally, industrial buildings are the larger, more modern buildings, principally in life sciences, and offices that are suitable for and attractive to either government bodies or multinationals. The team has been doing this since 2014, and we've invested over that time, and we have invested just over 5.5 million of our own money in this strategy. So we believe in this strategy. It's a high income, high quality portfolio. I'll come on to that later, but we pay out our quarterly income, less any reserves for capital expenditure, as dividends. And as you'll see, that dividend is one of the key attractions of the investment. But a company that pays out high dividends would be nothing were it not secured on high quality assets. And we have managed to improve the value of each of our properties since purchase. And again, I'll be covering that later. If you move on to the next slide, please. The fundamental economics of Ireland are very supportive for our strategy. Ireland has been one of the best, if not the best performing economy in Europe over each of the past 5 years. And that's driven by its inward investment policy, which successive governments have been very successful in attracting high growth industries into the country. So advanced engineering, ICT, technology, and life sciences. Those companies come for a number of reasons. They come because there's an open economy, there's a relatively effective tax rate. More importantly, the country is situated as part of the EU, which is a great attraction especially for American multinationals. And finally, and most importantly, most companies come because of the young, very highly educated workforce. Almost 23 or just over 23% of the Irish workforce is employed directly or indirectly by multinationals. And those companies, those employees earn far more than the national average salary. So these are high value jobs. And since 2018, more than 50% of that investment has been outside of Dublin. And because this has been going on for a number of years, you've seen the growth of industry clusters. So businesses, like-minded businesses, situate close to each other because there are specialized supply chains, the further education colleges and universities and research institutes produce research and students which are appropriate for those businesses. So we see, for example, in the Midlands, going out to the West Coast in Galway and Sligo, a life sciences triangle, a golden triangle of life science companies. And we see similar clusters in Cork, Limerick, and elsewhere. If you move to the next slide, please. I'm not going to speak too long for this slide, but we were floated in 2018, and since then we built a portfolio of high quality institutional offices and industrial properties with a very good tenancy mix, where governments, multinationals, and large corporates make up over 97% of our rent roll. We had some smaller, non-core, non-institutional properties. We sold 2 of those just after these accounts, and we've entered in agreement for sale of the final one. So we will have no retail exposure and no non-institutional properties by the end of next month. You can see from the bottom slide, which is stolen from Charles, so I'm going to leave it to him, that there's been a rapid growth in both our revenue and valuations of our properties. With that, I'm going to pass to Charles to take you through the numbers for June. Thank you.
Thank you, Jonathan. So if we look at page 9 of the presentation, in the top left-hand side, you see a chart which shows effectively the story for the first 6 months of this year. We started off with a NAV, in this NAV progression, of 100.03. Net rental income for the period was collected. Our collections were 99%. That's a reflection of the strong credit nature of our tenants, being majority FDI and government tenants. So we had strong collections in the first 6 months. On top of that, we kept a grip on where costs were. Jonathan's already mentioned our own ownership of this, and I'll come to another example of this in a moment. We listed on the main market of Euronext, which was required under the Irish REIT rules within 3 years. As such, we took on an exceptional cost. We do not expect that cost to ever have to be suffered again. We paid quarterly dividends, as we have since the beginning of 2019, to shareholders, and the dividends paid in the period were for Q4 of last year and Q1 of this year. Subsequent to the end of that year, Q2 dividend has been paid to shareholders. We purchased further assets to increase the size of the portfolio, took on some acquisition costs from those. However, the valuation of the portfolio by the external valuer at the half-year point showed a valuation change which was significantly greater than those acquisition costs. We raised further equity capital as well through a share issue and took some costs there. However, looking at all the activity we've done over the 6 months, our NAV grew from 100.03 to 100.64 over the period. On the right-hand side, we look a little at our revenue and how that's changed over the period. Chief there is our rent. And what we look here is we look at our annualized rent roll. Start of the year, 10.9 million euros. Increases were partially from lease amendments and renting some vacancy, but the majority of it was from purchases. In the period, we purchased 1 industrial property and 2 office properties for 19 million euros in aggregate. That meant at the end of the period, we had an annualized rent roll of 12.8 million euros. At the same time, vacancy was reduced to just under 5%, and the weighted average tenor of the portfolio, both from a break and to a lease end, extended by half a year and 0.6 years to lease end. If we look at the next page, we see how we've grown since IPO. Since IPO, we've grown by 6.5 times. But the chief thing here is, while the portfolio has grown, the rent roll has grown in lockstep with it as well. When we went to shareholders with a portfolio, we said we could source and purchase further assets of a similar type and similar returns going forward. And I think this graph that we have there shows that we've been able to do that, and we have a pipeline that means we could continue to do that in the future as well. An important part of our portfolio is the fact that our portfolio is currently under-rented, such that our annualized rent roll, if it were to be reset at the market level, would be greater than it is today. If we look at the chart in the bottom right-hand side, this shows how it's progressed over time. The brown line that passes through this from the bottom left and up to being relatively flat at around 5% on the right-hand scale, that is a measure of the over-rental on day one with the IPO quickly moving to being under rented by around 5%. So we've maintained our ability to buy under rented assets. So we have the opportunity to work those assets in order to increase the rent received from those same high quality tenants who provide us with a 99% collection. And if I look at that ERV gap, so to speak, between where our annualized rent roll is and where the ERV would be, and the ERV is the third-party valuer's view of what the ERV is. That's split roughly 50-50 between vacancy for us to let, and at the same time, the gap between let properties and the let properties ERV. Bottom left, I've talked about cost before. In order to show where we are from a run rate perspective, as well as including the June 21 numbers here of administrative costs over portfolio, and these are annualized administrative costs, I've also shown it without the exceptional to give an idea of where our run rate is. And what you see here is while our administrative costs increased slightly, excluding exceptional, it increased by less than the portfolio itself grew. To a certain extent, showing operational leverage, I'll mention about in a moment. This increased revenue and focus on costs feeds through to dividends on the next page. What we show on the top is we show our quarterly dividends since we first started paying them in 2019. And you'll note we have paid them throughout the pandemic to date. If we look at the bottom part of this slide, it shows that when we look at assets, we don't just look at the income or revenue that may be earned from them and the stability of that, which we've demonstrated through our dividends and collections. In the bottom half, what we see is what we've done from a value of the portfolio perspective. Every time we purchase an asset, we suffer purchase costs, and those are around 8.5%, the vast majority of which is 7.5% of stamp tax. So therefore, when we purchase an asset, we have to have a plan in order to recover at least that amount of the property, of the value. What we do on the right-hand side here is we show how the portfolio has performed on a like-for-like perspective since the beginning of 2019, when it had reasonable size and diversity. What you will note on the right-hand side is it's just the first half of this year. 2019 and 20 are for full years. However, what we see is in 2021 already, we have almost the same growth as we had in the whole of last year, and we had for the portfolio, and over the amount of growth we had for offices. So that shows that we're still able to increase the value of our assets, even going through the unpleasantries of the pandemic we have been through and we still find ourselves in. If I look at the portfolio in its entirety, it has grown since December 2018 by over 10%. So above the target that we had set ourselves in purchasing our assets. The following page looks at a reduced income statement. And because the exceptional cost of the main Euronext board listing is not expected to be suffered again, I've included an excluding exceptional column, which is in the center as well. If I compare where we were from a revenue perspective, beginning of the first half of this year versus a similar period the year before, you'll see an increase. It's a slight increase. Part of that is the purchases that we made earlier this year, which increased that annualized rent roll, were in May and June, so late in the period, so we didn't get the full benefit throughout the 6 months. However, an increase in net revenue. Then we see fair value gains. First half of last year was a loss of 1.8 million. First half of this year was a net gain of 2.1 million. And that is 2.1 million after the costs of purchase of 19 million euros of assets. As such, we ended up with, if I exclude the exceptional, twice the total income from the prior period. From a cost perspective, we were pretty much flat from where we were on administration and AIFM costs. We did have the exceptional expense of 900,000 euros. Our finance costs were around the same too. What this means is if I excluding the exceptional, our costs were about the same as they were in the first half of 2020, yet we had a significantly larger portfolio. This means the profit for the period changed from 1.3 million euros for the first half of last year to the first half of this year of 4.7 million euros. And our shareholders got the benefit of quarterly dividends in the period. 2.55 cents were paid in the first half of this year, and for the first half of last year, 2.45 cents. So an increase on the prior period. However, let's not just look at the income, let's look at the value we have in the portfolio on the following slide. This shows a summary of the balance sheet, at the top of which we have the investment properties. That's not all the investment properties, however. There are some other investment properties held for sale. These are 3 properties we have owned since the IPO, which were part of the seed portfolio. They had the benefit of the IPO and the early part of the REIT's life, in they were relatively over-rented. However, they included retail assets. So therefore, we have decided that they are non-core assets and they were to be sold. Of those 3 assets, 2 were sold in July at above their book value. We have one of the assets still remaining that is due to be sold in the second half of this year. And once that's sold, we will have no retail assets in our portfolio. What this shows in comparison with the 31st of December 2020 is that we've had an increase in the size of the portfolio itself. We've maintained good liquidity, an increase in cash and cash equivalents, and we've increased our drawings on the debt facility from 38.5 million to 49.6 million. We still have a little bit of our debt facility available, and we have the opportunity to grow that further in order that we can get to our target of 40% LTV. Our LTV at the half-year point stood just a shade under 30%, and on a net debt perspective at 23%. At the bottom of this, again, you see, as was shown in the progression earlier, a move in NAV, IFRS NAV, from 100.03 to 100.64 over the first 6 months this year. So where does this leave us? First of which is the investment property side of things. We expect to see our investment properties grow. We have a development at the moment that we're in the middle of doing. We'll mention a little more about this as that comes, but as that development is completed, which is due to happen in the first half of last year, we will start to see the rental income grow from there. At the same time, the investment properties, other than via purchase, we work hard to increase the value in those, as you've seen from earlier in the like-for-like property changes in value. From an income perspective, we have vacancy and the reversion I mentioned beforehand to increase the revenue from the assets that we have at the moment. And the last point is we have operational leverage. We've demonstrated that we can keep a grip on costs while growing the portfolio. As such, additional capital and further assets should mean that that additional revenue should pretty much fall through to being paid out to those quarterly dividends we've been paying since the beginning of 2019. With that point, I'll pass over to Jonathan on the portfolio itself as the driver of that revenue and that value gain.
Thank you, Charles. Thank you, Tim. This slide shows the overview of the current portfolio, 164 million of assets. If you look at square footage, approximately 22% in industrial, 78% in office. Looked at by rents, 55% in the greater Dublin area, 45% rest of the country, just shy of 920,000 square feet. You can see there the yield to the company, in other words, the rent divided by the value, 7.5%, with a reversionary yield of 8.4%. In other words, still more rent to be captured through asset management. Our current vacancy rate, just under 5%. And you can see on the right-hand side, the list of our top 10 clients. These are all very strong companies or government entities, ESB being Electricity Supply Board, for example. I think the only non-public company in that list is Aldi, and they're an exceedingly strong private company. If we look at the next page, you see a map of Ireland and our current properties situated on that map. Now that we've excluded from this our non-core properties, and you can see in Dublin, our properties are situated principally in the suburbs or just outside the ring road. Across the rest of the country, we're situated on business parks, close to institutes of technology, in areas that we see an excess demand for property from multinationals and a shortage of supply, all of which is good for rental growth. If we move to the next page, what we've done here, and on the following page, what we've done is done some analysis of the value drivers. When Charles showed you the increase in like-for-like values, I think it's useful understanding how that has happened. So we've broken our office portfolio into a Dublin and a non-Dublin portfolio. The only reason for doing that is rents in the Dublin area are significantly higher and therefore skew the analysis. But what this page shows you, and I'll explain it a little bit, is how and why the values of our offices have increased. In the bottom right-hand side, what we can see here, the line, the slightly red line or brown line, which moves from somewhere in the region of, the dark brown line, somewhere in the region of 155 euros a square foot to close to 182 euros a square foot is the capped value per square foot of our properties. So the properties have increased in value. And the question is why? It's not because the valuers have tightened the discount rate at which they think people are buying. At the top right-hand graph, you can see the discount rate that's applied to our portfolio. And frankly, if anything, it increased in the first couple of years of ownership and has been steady at approximately 7.5% since then. The driver of value in this portfolio is twofold. One, rents have been increasing. In the top right-hand graph, you can see both the ERV, in other words, the valuer's assessment of market rent, and the actual rent we receive have both been increasing, and fairly consistently, ERV is above the rent we receive. In other words, we are under rented, as Charles has said. The bottom slide shows both the vacancy in the portfolio and the WALT, the average length of the tenancy in the portfolio. You can see the average length of tenancy has increased from just around 2 years in the early part of this public ownership to over 4. That's walk to break. And the vacancy has reduced fairly substantially from over 26% in June 19 to 8.4% today. As I said earlier, the vacancy in the entire portfolio is under 5%. So the value increase in this portfolio, this part of the portfolio, is entirely down to asset management. If we move to the next slide, the industrial side of the portfolio shows a slightly different story. There has been relatively little asset management in the industrial portfolio, not because we don't want to do it, but because the leases have not yet come to lease break or rent reviews. There's only been one rent review across our entire portfolio of industrial properties. However, you can see that rents have been increasing, which changes the value, but more pertinently, the discount rate has been tightened. In common with the rest of Europe, industrial properties are in short supply and in great demand, and therefore, both by tenants and by investors, and discounts have been tightening. However, as you can see from the top right-hand graph, our current discount rate on our portfolio is just under 7%. If I refer to current recent transactions in the market, both for good secondary assets and primary assets, we have seen transactions at as tight as 4.5% and as wide as 5%. You can see, from my perspective, that there is a significant amount of value to be gained. And more interestingly, we are now coming to the point at which we have some asset management in that portfolio, and that will also add to the WALT and increase rents and values. If we move to the next slide, you can see an example of what I'm talking about. At the top right-hand corner is a photograph of our campus in Athlone. All of the tenants in this on this IDA estate are in life sciences. We have 4 tenants across 5 buildings, plus a car park marked out there. Now, most interestingly, there is no spare capacity for any tenant to expand. There are no empty buildings and no neighboring plots where they could move. So if somebody wants to grow, they either need to leave Athlone or they need to have built or build an extension. That's exactly what has happened with our tenants in Building B, where they have 200 new jobs, they're in vaccine development, and we're in discussion with them for some time, and we are currently building an advanced extension, 37,000 square foot to the existing building, with labs, clean rooms, offices, and research space. That 37,000 square foot extension will cost circa 10 million euros to build, and will, on completion, benefit from an 8-year lease at 950,000 euros a year. Significant return on our investment, and an illustration of what one can do with a high quality tenant base in a space constrained location. If we look at the next page, you will see an example of how we manage our offices. The Millennium Park, we bought Millennium Park in February 2020. There were 6 buildings, one of which was empty. And at the time we contracted to buy this property, which was late 2019, the valuers saw the ERV, the market rent, at circa 15.50 to 16 euros a square foot. We bought because we thought that the property was going to, the area location was going to improve in value because of the new motorway, which we've highlighted on the map. What happened post-acquisition was we first of all let the empty building to Aldi, 15-year lease at 16 euros 50 a square foot, franking our view of the market rent. Since then, there have been a number of rent reviews, regears, and even a new lease in a small, one of the small empty offices, which have increased rents from 16.50 to the last transaction, which was agreed at 19 euros a square foot. What you can see is when we bought the property at 25.3 million plus costs, we have since, the valuation has since improved to 27.3 million in our last valuation. However, the 100% occupied, the yield at fair value, in other words, the rent divided by the valuation, the new valuation is 8.9%, which is equivalent to a net investment yield of 8.15%. That is much wider than we would expect to see in an office of this portfolio of this quality. And frankly, for one on the outskirts of Dublin, I would be expecting a yield more of closer to 7%. So we believe there is significant value in this office park, just as there is across our portfolio. If we move to the next slide, finally, we come to our ability to buy. I like Tanola House, the picture at the top, for the following reasons. It's a new building. There was one part of the building was completed in 2016. The second part of this building was completed only last year. Industrial buildings, especially new industrial buildings, are currently trading in the Dublin area at yields of approximately 4.5%. Anord Mardix, who are a US multinational specializing in data center security, they've got a long lease, and you can see we bought this at just under 7% yield, very, very cheap to the market, long lease, very dry asset, but one which has significant value. And really is a reflection of our relationships across the country, which allow us to buy buildings, we think, cheaply. Below that, we can see 2 office blocks on the City West Business Park, one of the premier business parks in Dublin, in the west of Dublin. Those 2 office blocks are home to 3 multinationals, principally Nestle with Diebold as well. The nice thing about this, from our perspective, is we bought at a very nice yield, net investment yield of 8.2%, and a very high reversionary yield, which means that our asset management in these buildings will bear fruit, and we expect those valuations to increase even beyond the latest value of 11.4 million. So if we move to the next page, In summary, the position in our market is very positive. The property market has performed very well, especially outside of Dublin. And that is because vacancy rates are low. The tenants and the prospective tenants are performing very well and need more space, notwithstanding any of the exigencies of the pandemic. Our current lease negotiations, our design and build activity suggest there is continuing demand for quality buildings, and we expect that to continue. You can see the strength of our portfolio and our rent collections. And now Ireland has reopened to international travel, and the government today announced that all final pandemic restrictions will be lifted on October the 22nd. We expect the investor market as well as the tenant market to pick up. The only question for Ugrove is how we capture our share of the market. We see a very rich pipeline in front of us, and in my view, any money we raise, we can spend quickly in a manner which is accretive for shareholders. And so the real issue for us is new capital. And with that, I'm happy to open to questions. Thank you.
Thank you very much, Jonathan. Thank you very much, Charles. I have had some questions typed in while you've been presenting, and a couple provided ahead of the presentation. But if anybody does have any further questions, please do use the Q&A button, and we'll do our best to go through them. The first question, and I think you answered it certainly to a certain extent, Jonathan, in the last slide. They congratulate you on building up an attractive portfolio and effectively managing the assets that you've bought. But as a REIT, you do remain small. Can you talk a little bit more about how you are looking to scale up the platform and grow the business? You obviously said, you can deploy capital as it's available, but give us a little bit more on the scale of the opportunity in the market, given your specific focus.
Yeah, no, you're absolutely right. We are small, and it is one of the major constraints to our business. Our current market cap is circa 125 million euros. Frankly, in terms of the assets we could buy, whether that's through forward financing or the secondary markets, or even through some sort of corporate finance activity, I'd be disappointed if we couldn't build the industrial portfolio to circa 150 million and the office portfolio to north of 500 million. Clearly, even with a good use of debt, that would require our market cap to rise to somewhere in the region of 450, 500 million euros. The $64 million question, or euro question for us, is can we access that money? Will the institutional equity market support us in doing that? So when I look at what's available, the market is large enough, and the numbers I'm quoting are by no means excessive. That would not require, we can manage more than 350 million with our current staffing. And frankly, we wouldn't need very much to double that again. So the real issue is not can we buy the assets, but can we finance the assets? That, for me, is the central issue for Ugrove today.
Thank you. And another related question. You've talked about the availability of new assets to purchase, but this one's about forward funding opportunities. Are you seeing other opportunities? And if you are, is it right to assume that the economics would be broadly similar to the project in progress in Athlone at the moment?
We are seeing more forward financing opportunities, and I shouldn't be too glib about forward financing. It's a fairly protracted discussion. First you need a tenant that's growing, and they should be one of your tenants, because clearly you need an in-depth relationship. Secondly, you go through a fairly long process of agreeing with the tenant whether their plans are realistic and achievable, and they then need to understand the likely cost of developing the building, and that involves, for us, that involves a third party, in other words, the construction company. Now we need to tie the construction company to a fixed price contract. That then throws out the sorts of rents we would expect, there are a number of parallel conversations that go on before you get to the start point. We are currently in discussion with at least 2 of our tenants to see if we can't get them over the line on forward funding. Whether the returns are identical to what we've shown or similar, I think the returns will be at least as good, if not better, than we can get in the secondary market. Not only are they tenants we know, but they'll be brand new properties, longer leases, with returns which are at least as good at or probably better than we can get by buying properties. And most interestingly for me, most of our forward financing, if not all of it, is in our life science portfolio. Now, that's relevant because life sciences today in Ireland is an area which is popular, but one in which the valuers have not yet caught up with investor interest, and investors have been constrained from buying or transacting because of their inability to travel. So we have been given a window at which we can grow this portfolio before the Blackstones of this world come in and start bidding yields down and prices up.
Thank you. And I had a general question earlier, just on the outlook for Ireland. Obviously, Ireland and corporate tax rates is something that's in the news quite a lot at the moment. Is this something that you're concerned about? And if there is pressure for the Irish government to raise corporation tax, do you think that will have any impact on yields that are achievable?
I don't think it will have any impact on yields. It's something we've looked at fairly closely. I was slightly surprised when the whole global corporate tax debate moved from a base rate of 21% to 15%. I was slightly surprised that the Irish didn't jump onto that, because the Irish tax rate at the moment is 12.5%. And it may be that their opposition to the 15% rate, or their stated opposition, is tactical rather than fundamental. It may be that they shift their rate to 15%, because there's little value in Ireland holding a 12.5% tax rate when most of their multinationals are US companies who will end up paying 15% anyway. However, the key point to understand about the Irish economy these days is, unlike the 60s, 70s, 80s, and maybe even the 90s, the multinationals based in Ireland are not here primarily or predominantly for tax. The days of abusive tax structures are largely past. That does not mean that some of the companies, mainly the software companies based in Dublin, like the Googles, etc., it does not mean that they haven't used Ireland as a place to park profits that might have been made elsewhere. But when we look at our investor base, our tenant base, whether it's Optum or PPP or KCI, who's now part of 3M, these are manufacturing companies. These are companies supplying services. They're not companies that hold significant IP in Ireland. They're companies that make a lot of money, but employ a lot of people. And I don't think that an increase from 12.5 to 15% will make any difference. In fact, what we've seen, and we tend to be a little bit behind in seeing accounts of subsidiaries, but what we've seen in the subsidiaries is those subsidiaries are paying tax currently. So they are paying tax to Ireland. The Irish corporate tax rate has gone up substantially over the last few years, and we expect to see that continue.
Well, thank you. That's answered the questions that I've had provided during the presentation. If anybody has got anything else, now is your final opportunity. If you can type quickly. But if you do think of anything after the presentation, please do get in contact. Our contact details are on all the announcements. I'm Tim Metcalf from IFC, Company's Financial PR and Investor Relations Advisor. Please get in touch at any time and we'll endeavour to answer your questions. Well, I can't see anybody typing quickly, so Jonathan, Charles, thank you very much. And thank you very much indeed for everybody who's taken the time this evening to join us. Thank you.
Thank you, Tim. Thank you, everybody. Have a good evening.
Thanks. Bye-bye.